Good morning, Thursday morning, investors, traders. If it's Thursday morning, it's the weekly state of the market. Actually, we tend to do this later in the afternoon. Unfortunately, I have a scheduling conflict today, so I am recording our weekly state of the market bright and early Thursday morning at about 7 o'clock a.m. Let's take a quick look at the futures here. And futures are under pressure, mostly NASDAQ futures on the heels of Tesla's Q2 report. As you can see, that's down about $11 in the pre-market for whole number sake. And Netflix is down a good $33 there in the pre-market as well. I'll go out on a limb here because the reports were actually pretty good. I think we're in an environment whereby these are going to prove dip buying opportunities before too long. With that being said, let's jump into our weekly state of the market. Investing is fun and exciting, but dangerous if you don't do any work. And unfortunately, with the invent and rise of financial media, social media, you got to do a lot more work than you had to, before the information technology era, because there is a lot of misinformation, misleading facts, lack of context around what would otherwise be known as factual information. So you got to do a lot more work than maybe you ever had to do in the past. So far, if you are an active trader or active fund manager who participates and partakes in information dissection, absorption, and all that, because just a lot of it is garbage. I hate to say, but a lot of it is, especially that which comes from the financial news media networks. All right, so a couple things I recently quoted here. While so many worry about trying to grab a few pennies in front of a steamroller, we could actually be picking up gold coins in front of a tricycle, right? This is basically just an analogy or metaphor referencing the old colloquialism suggesting that, when the market's long in the tooth, you might be picking up pennies in front of a steamroller. But if you think big picture, if you think long term, the long-term cycle is up. Market goes up over time. So you're actually, no matter where you are in the cycle, if the market's down, you're getting value. Pick up that gold coin. It may not look like a gold coin at the moment, but it will in the future. Think back to October of last year. October at the lows, people were saying, don't try and pick up pennies in front of a steamroller. Don't fight the Fed, so on and so forth. But if you picked up those pennies back then, today they look like gold coins. And the concerns about the Fed, the concerns about the economy, they really were just tricycle-sized worries and not steamroller-sized worries. Optimism wins. Pessimism may lose less, right? If you're pessimistic, if you're cautious, you might lose less. But between the two, optimism and pessimism, only one of them has actual gains. That's optimism, putting money to work, buying the dip, always having a glass half full type of approach to investing. All right, here's something else, and this speaks to disciplines, right? When we talk about investing disciplines, we tend to think of them in three forms or three disciplines, practices, if you will. They would be fundamental analysis, technical analysis, quantitative analysis, right? Those would be the three disciplines of investing. And some people, they try to become an expert in one and forsake the other two disciplines. And I think that's a disadvantage or disadvantageous to the potential that you have to achieve even greater investing returns. So the way I look at it is pretty much captioned in this quote here. I'm a technician. I'm a fundamentalist. I'm a quant. We all work within the market circus, if you will. But if you limit yourself to a single basis of study or a single discipline, You could be the worker in that circus who shovels elephant poop. And nobody wants to be the worker in the circus that shovels elephant poop. You want a broad discipline. You want to be able to do different things in the circus other than shoveling poop. And that probably takes dedication, hard work, and a multifaceted approach to that kind of work. The same way it would take multiple disciplines to excel at investing. All right, so be careful of the financial media, folks. This chart, this is from a recent study late last year from David Rosato, and he identifies the emotional payload. Think of it as triggers, emotional triggers in media headlines. And here, he labels each trigger or each payload and their corresponding trend with respect to how they are fashioned in media headlines. Anger, the trigger, the human emotion associated with anger is extrapolated by media headlines in an ever-increasing fashion. Fear, ever-increasing fashion. Sadness, ever-increasing. Disgust, ever-increasing. So we tend to click on articles that make us exude this type of emotion. Joy, that's descending. We don't click on things that tend to trigger joy. We don't click on things that basically don't trigger us at all. It's the things that trigger fear, anger, sadness, disgust. So if you wonder why the media slants, in one direction, these particular triggers, which are bad, it's because they know we're going to click on them. They know that. It's kind of a disgusting practice, if you ask me. But what is the media? I mean, how are they funded, right? The bigger the audience, the more people that the advertisers can reach. So if you're thinking that, well, this is going to make me smarter because I read it and it's cautious, it's pessimistic, it's triggering some kind of emotional, vitriol, well, it's probably not good for your health. And it's probably not good for your portfolio. Remember, things actually get better over time. They don't get worse, if you think about it that way. All right. And what you don't want to do is let the headlines drive you out of the market. Can you imagine if you had listened to all of the different Wall Street strategists and everything that they proposed and espoused to on the financial media networks over the last 6-12 months? Good gosh. I mean, we're within 5% of the all-time highs in the S&P 500 since the October lows. And through the majority of this bull market rally, all you heard was bear market rally, narrow breath, all the things that would, scare the average investor out of the market. You got to stick with the market, folks. Media often gets it wrong. Wall Street often gets it wrong, more often than not, actually. Here's a lesson from Peter Lynch. Peter Lynch is one of the most famous and successful Wall Street fund managers of his era. He managed the Fidelity Magellan Fund from 1979 to 1991. The average returns for the Magellan Fund over that time period were 29% annualized. Are you kidding me? Not just the best of his era, but one of the best of all time with that kind of result. Here's the problem, though, right? You're managing funds of individual investors. Did the average investor in the Magellan Fund over that period receive that 29% annualized return? No, not even close. Why? And let's read here. During his tenure, Lynch trounced the market overall and beat it in most years, racking up a 29% annualized return. But Lynch himself pointed out a fly in the ointment. He calculated that the average investor in his fund made only around 7% during the same period. When he would have a setback, for example, if the market was down, the fund was down, the money would flow out of the fund through redemptions. Clients wanted their money back. Then when he got back on track, when the fund was back on track, moving in a positive direction, flows would move back into the fund, but they already missed the recovery. You're not going to time in and outs, folks. You're not. You're not going to be that unicorn. None of them were from back in Peter Lynch's days. You get out when things are looking bad. It's scary. It's eliciting fear. And you're trying to get back in at the right time. You're trying to make two smart decisions. Good luck with that. The market often doesn't satisfy the majority in that way, as exampled by the Magellan Fund's performance and the average investor in the Magellan Fund. One of the other things Peter Lynch wants investors to recognize through good times and bad times, corporate profits have grown 8% a year historically. So corporate profits essentially double about every 9 years. Therefore, the stock market should double about every 9 years. There will be a great deal of noise that ushers investors towards the exits, but be more focused. This is for me. There will be a great deal of noise, financial media, Wall Street pundits, that ushers investors towards the exits, but be more focused on tipping the waiter that has pulled your chair out at the table. Focus on the people that keep you in the market, not those that basically scare you out of the market. Good lessons from Peter Lynch in a quote from myself there at the end. There's a lot of myths out there in the market. We did a lot of myth busting last week, but I do want to revisit and highlight the issue with suggesting that the yield curve is always right. First and foremost, the last 3 times the yield curve inverted, 3 or 4 times that the yield curve inverted prior to a recession, because we did have a recession, you could make the claim that there really was no normal counterfactual for those occurrences. Why? Well, think about the yield curve inverted in 2000, and we subsequently had a recession in 2001. But what did it take for that recession? It took an exogenous event. It took 2 idiots flying airplanes into the World Trade Center towers. Is that normal? No, of course not. That was an exogenous event. Did the yield curve cause these idiots to do what they did and kill thousands of Americans? Of course the yield curve didn't cause that. It wasn't correlated with that action. So we don't really have a counterfactual suggesting that there's a correlation there between the yield curve and a subsequent recession. Fast forward to 2008. Yield curve inverted in 2006, folks. Did the yield curve cause the great financial crisis? Of course not. That was gross deleveraging. I'm sorry, gross excess leveraging, I should say, and gross deregulation in the housing and mortgage market industry that caused it. We were doing bad fiscal policy. And it resulted in an exogenous event. But the yield curve didn't cause bad economic policy. Yield curve didn't cause deregulation. Yield curve didn't cause just excess leverage in the system, just bad behaviors, which resulted in an exogenous event in a great financial crisis. Fast forward to 2019, another yield curve inversion, and we subsequently had a global economic shutdown due to a once in 100 years pandemic. Did the yield curve inversion cause the pandemic? Of course not. We all can think about this logically, folks. So when they say 8 of the last 8 yield curves have resulted in a recession, well, at least 3 of them, we don't really have a true counterfactual. And the reason why they say 8 out of 8 instead of 9 out of 8 is because if you go back to the last 9 yield curve inversions, 1966, it did not result in a recession. We didn't have a recession until 1970, 4 years later. So how logical is it to say that the yield curve is a signal of a pending or looming recession? The reality is it takes 24, the average lead time between the yield curve inverting, and we're looking at the 10-month, the 10-year minus the 3-month. The lead time between the inversion and the recession is 24 months. Let me ask you a question. And this is going to sound, salacious, but it's honestly, sometimes you have to think in extremes to extrapolate the reality of what we're discussing here. If I punched you in the face, I know that sounds a little harsh, but if I punched you in the face, are you waiting 24 months to respond? Sounds ludicrous, doesn't it? And that's the point here. Anything that takes, on average, 2 years to occur post a signal or event, you've got to be kidding me. It's ridiculous. It's a ridiculous notion. We can, again, when we sit down and we rationalize these things around the economy and the market, these supposed correlations, they don't make any sense whatsoever. And we can example it in so many different ways. But it takes time, it takes work to think about these things, as opposed to the ease of, well, I'll just watch CNBC here for a minute, right? And, here's a chart also identifying the correlation, right? In coefficient terms, correlation coefficient between all the different yield curve spreads, all the different ones in here, and 4-quarter forward GDP. In order to have a true correlation, the coefficient needs to achieve 0.80 or better. None of these are 0.80, folks. Not a single one. None of them are correlated with 4-quarter forward real GDP. No matter what way you look at this, either if you think my example was ridiculous about punching you in the face and your response time, or a valid chart of correlation coefficiency historically, there's just no correlation between the yield curve inverting and the outlook for GDP, how the economy performs going forward. We did a similar myth debunking when it comes to, the Fed's balance sheet versus the S&P 500 last week. And just as just to highlight once again, Michael Santelli, thank you for broadening our perspectives in financial media form. But he's showing a chart, the relationship issues with the S&P 500, which has been traveling higher, and the Fed's balance sheet, which has been traveling lower. But we've long since known this. We've done this in the past. Here was another occasion: the Fed's balance sheet rolling over, traveling lower, and the S&P 500 moving higher from 2015 up to 2019. What people think about, what is the friggin' plumbing that is involved to try and connect the Fed's balance sheet, a totally and completely different entity, from the S&P 500? Where's the button that the Fed presses to align the two? What's the lever it pulls down on to align the two? These are ridiculous notions. They're ridiculous. The connectivity people might assume, right? Because it's plausible. And that's the thing that a lot of investors will do. It sounds smart. Think about this. All right, for 40 plus years, going back to the 1980s, the Attorney General, through various studies, suggested, well, it laid claim to, at the time and over the last 40 years, tooth decay and gum disease can lead to heart disease. In other words, they're correlated. If you have tooth decay, if you have gum rot, gum disease, you're going to have heart disease. That's what people thought for 40 years. I mean, it's from the Attorney General, it's the FDA, it's all of these different American Heart Association organizations that believed this for 40 plus years until 2021. where Harvard did a study and there was no verifiable connection between the two. Now, it sounds plausible, right? Well, what goes into my mouth, how it goes into my mouth might affect the rest of my body. It sounds plausible. We can think about it, and it's logical almost. But what goes into your mouth goes into your stomach. You're digesting that, or you're pooping it out. When does that ever hit your heart? But we kind of stop at the whole, well, it goes into my mouth, so it goes into my body. My heart is my body, so therefore, takes work, ask why. My father used to tell me, he's like, Seth, if you ask why 5 times, you'll probably get the right answer. So sometimes we just don't ask why enough. All right, moving forward, let's look at some quantitative studies about the market, right? Let's get into the market a little bit more. We can obviously connect, the economy, the macro backdrop with the markets, but here we are, we're, at the tail end of July, and usually this is where, right, we're leaving the sweet spot. We're leaving the sweet spot of the market cycle, and we're entering that part of the cycle where gains are harder to come by. The last 10 days of July, historically, this goes back to 1928 also, last 10 days of July, the percentage of the time the market is up is only 60% of the time. And look at the gains. They're rather meager, whether it's the average or the median. Very meager. What about the first 10 days of August? A little bit better on average, much worse on median. And now we're talking about a coin flip. 50-50 chance the market will be positive. Last 10 days of August, same thing, 50-50. It's a coin flip. Where it really starts to get bad is, or the market is less friendly, the first 10 days of September, last 10 days of September. Look at the returns. They're negative. Negative. And more often than not, market does go down September. So, we have left the period where there was higher probability of positive returns and average or median gains. We're entering a spot where gains may be harder to come by. Look, on any given year, anything can happen, but all we really have as investors are, what are the probabilities? And you want to, you tend to want to lean into the higher probability. We can't predict the future, but we can understand the probabilities going forward. Now, after September, look, October is not a whole lot better, but it is indeed better. The last 10 days of December, folks, right? You heard about the Santa Claus rally. Well, it starts the last couple of days of September. 71% of the time the market is positive. I know that's a long way from here, but what I would be anticipating is some kind of, because keep in mind, we have not had a 5% drawdown in the S&P 500 since the trough in March of this year. We have not had, so we're edging up to like 80, 90 trading days without a 5% correction. The average calendar year has 3 5% corrections. So it's just something to keep in mind. I'd be of the opinion that those will prove opportunities should such a consolidation phase take place. We've talked about this analog in the past. As a refresher, and we'll get to why we're refreshing this analog, because it has played out perfectly, folks. The 1966-67, you heard me mention 1966. Well, maybe not the date, but the yield curve inversion, right? 1966, yield curve inverts. We don't have a recession until 1970. 1966, midterm election year. 2022, midterm election year. 1966, 22% bear market without a recession. 2022, 25% on a closing basis. Bear market without a recession. What happened in 1966 going into 1967? And by the way, the market bottomed in October of 1966. When did the market bottom? In October of 2022. Going into the following calendar year, Here's what happened in 1967. Doesn't it look like a lot of what has happened this year? So if we look at the 9 months, right, here's 1966, 9 months into the recovery off of a non-recession decline of at least 19%, well, 25%. So it went from October to July and gained 25%. Guess what the rally from October to present day has been? 25%. Folks, this wasn't an accident. We first highlighted this in December. So going back to last year, we said be prepared. There were too many similarities between 1966 into 1967 with 2022's bear market. And lo and behold, perfect. We'll see what happens going forward because this is about where we are in the 1966-67 analog with today. Gains are harder to come by. Nice study here from Chris Shivako of Shivako Capital. Last week, the percentage of NASDAQ stocks greater than their 200-day moving average completed a rare round trip after being oversold in 2022. Again, we're talking about the NASDAQ and stocks above their 200-day moving average in the NASDAQ index. It went from less than 10% of the NASDAQ stocks above their 200-day moving average to more than 80% above their 200-day moving average. Historically, going back to 2002, it's only happened 3 other times. Here were the forward returns after that event. Up 100% of the time, 6 months later, up 100% of the time, 1 year, so on and so on and so on and so on. But they're saying it's a bear market rally. And that's a breadth study. When we look at the percentage of stocks above their 50-day moving average, 200, whatever it is, that's a stochastic breadth study, breadth analysis. And we can do the same thing for that we did for the NASDAQ on the NASDAQ 100, but this time we're going to look at the new highs minus the new lows. Are we making more new 52-week highs in the NASDAQ 100? Are more stocks making more 52-week highs, or are more stocks making 52-week lows? Last year, it was bad. Most stocks were making repeatedly 52-week lows. This year, it's flipped. This was bearish. This was bullish. Most of the time, stocks are making 52-week highs. So we have net new highs taking place in the NASDAQ 100. Breadth has been extremely bullish this year in the NASDAQ 100. Here's another study we've highlighted in the past, but again, just as a refresher, since we're talking about the NASDAQ and we know that the NASDAQ has proven leadership this year, more evidence stocks are likely to trend higher in this study from Ryan Dietrich of Carson Research. And so this one is the NASDAQ 100, new 52-week highs after more than 6 months. So we haven't had a 52-week high in the NASDAQ 100 in more than 6 months. And we finally did that on 5/18. We hit a 52-week high in the NASDAQ 100. We've done so in the S&P 500. We've done so in the Dow. We've done so in the S&P 400, which is the mid-cap index. We've done so in the NYSE Composite Index. All of these indices are making 52-week highs. Sounds like a bull market to me, folks. But for the NASDAQ 100, after it's made, and this was May 18th, it made the 52-week high for the first time in 6 months. The forward 1 month return, usually positive 78% of the time. 3 months return, so May to June 18th, July 18th, right? That's 2 months. Usually 3 months later, the market is positive 85% of the time. Average return 2.3 or median 3%. Folks, the NASDAQ has already gained 9% in 2 months. Not 3 months, but 2 months from the signal date. There are going to be folks that believe that we pulled forward way too much returns. And that could be possible. Heck, I mean, we've expanded the multiple. I mean, again, I said Netflix report was pretty good. Tesla's report was pretty good, but they've already, priced in these earnings. So if you get, some consolidation in price, that's really just normalizing the PE ratio. Netflix in the pre-market, 447.80, still down about $30. NASDAQ was up 8 consecutive weeks. That goes back to June 16th. And then the next week it was down. The NASDAQ was down the very next week, but it had an 8-week winning streak. 1 week later, the market, it's a coin toss. But a month later, which is how far we've traveled, right? 6/16, June 16th, we're now at July 18th. The market has, I think the NASDAQ is up, let's see. 1 month later, the index has gained another 570 points. So from the signal date, the NASDAQ composite was up another 570 points, which is roughly 4% in 1 month, which is, look at that, folks. 4 weeks is about a month, right? The median return is 3.69%, just about the 4% it's traveled. History repeating. More importantly, 13 weeks later, which is the equivalent of basically three months, the market is higher by 8.49%. The NASDAQ higher by 8. The positivity rate is even greater at 83% of the time. The NASDAQ is positive after an 8-week winning streak. Lean into the probabilities, right? Now the Dow is up 8 straight trading days. The Dow Jones Industrial Average is up 8 straight trading days, and this comes to us from the Almanac Trader. And what it shows is 1 week later, look at the positivity rate. 2 weeks later, 3 weeks, 4 weeks, 3 months, sorry, 1 month and 3 months. So if you think if you thought this 8-week winning streak for the NASDAQ was nothing, the positivity rate tells you it was something. If you think that this 8-day win streak in the Dow is nothing, history tells us it was something. There's 54 other times this has happened. It's not like, the sample size is a handful or two. It happened 54 times. It's a big sample size, folks. Pay attention to the positivity rates. Again, we can't predict the future, but the probability that the Dow Jones Industrial Average will be higher over these time spans is quite significant. Some charts to get into really quickly here. The NASDAQ technology, or the S&P 500 technology sector, has hit an all-time high. What happens when the technology sector hits an all-time high for at least the first time in 3 months? Well, let's see. Here's the Qs, and here's the technology sector performance going out 1 week, 1 month, 2 months, 3 months. This is the Qs, NASDAQ 100 ETF, 1 week, 1 month, 2 months, 3 months later. And again, we go to how many times was it up a week later? 7 out of 11. A month later, 7 out of 11. 2 months later, 8 out of 11. 3 months later, 9 out of 11. So the positivity rate actually goes higher, and the returns, the average returns, are higher the further you go out in time for the technology sector, and pretty much the same thing here. Higher returns the further out in time. And the positivity rate is much better, because here it's almost 50-50. 6 times up, 5 times down 1 week later. And this just happened, by the way. Chart dated the 18th. All right, let's move on. We've looked at this before. S&P 500 is up more than 10% through the end of the first half of the year. Generally, returns were positive in the back half of the year, almost every single time except for 1975. But if you look at 1975, through the first half of the year, the S&P was up 38%. I mean, yeah, right? You're going to fall from there. But nonetheless, let's get into this. Basically implies The year end, if we get the average return, when the prior year was negative and the current year is up greater than 10% at the end of the first half, the rest of the year has gained at least 6% and an average of 12% in the back half of the year. This basically implies that the year-end S&P 500 price could be between 47.35 and 49.85 by the end of the year. Another chart looking at value versus growth, how do you want to position your portfolio? Do you want a lot of growth stocks? Do you want a lot of value stocks? Folks, after an oversold bounce, because we did bounce right there in the value versus growth. It's been on a downtrend. Value has underperformed growth since the very start of the calendar year. After an oversold bounce, value versus growth has only found another low. It has only taken 6 months to unwind some 70% of the outperformance. Here is where value was outperforming growth all last year. We've erased 70% of that outperformance. So we have like 5.5 months left in 2023. How do you envision this performance ratio ending the year? Well, let's get an update from this chart. Was taken on the 13th of July. As of the 18th, it just kept falling. Just kept falling. Again, here is where value started to outperform growth in 2020. It's funny, it starts at the very start of the calendar years. Start of the calendar year, outperformance. Start of the calendar year, underperformance. Market does have dynamic shifts at the start of new calendar years. It happens that way. But we are on the cusp of erasing 100% of 2022's outperformance. And how many times did you hear folks profess and project that value would outperform growth over the next 5 and 10-year period? We're in a new regime, they said. And we may very well still be. But 2023 may not be part of that longer-term forecast based on what's taken place to date. Another chart looking at the median stock performance by way of the value line geometric index, because that's essentially what it measures, the average stock or median stock's performance. And since the October low, it's up almost 20%. This chart again from July 13th, we can see the value on the value line geometric index at 588. It needs to get to 594 to start a new bull market for the average stock, to call it a new bull market for the average stock, right? That's a small push, just one more push. An update as of July 18th, the value line geometric index is now at 590. So it's gotten another push, 4 more points, and it's, again, it would be illogical for folks to say it's not a bull market. Yeah, well, it's just, the top stocks are carrying the market higher, but the rest suck. No, the rest are in a bear market, assuming we get to 594 on the value line geometric index. AD lines, right? The S&P 500 advanced decline line has made an all-time high. The Dow Jones Industrial Average, advanced decline line, all-time high, and the mid-cap S&P 400 has made a new all-time high for its advanced decline line. Bull markets, bull market behaviors. Here's a chart that was from David Keller on Amazon, noting the prices going up. That's the top panel here. The Amazon stock going higher. But look at the RSI has been in a month-long bearish divergence. RSI is trending lower while price is trending higher. The price at the time was $128.87 when, noting the deadly bearish momentum divergence on Amazon. Deadly. It's deadly, folks. By the way, when I did this chart on the 12th, I don't see the date here, but I did my chart on the 12th. I was noting the same thing because it was still, the RSI was still weakening. And we went from $128 to $130.80. So not so deadly. But by the way, from here, $130 with a bearish divergence in the RSI. Oh, you can already see from there, but it went as high as 135.99. I think it was higher than even that. There's 136.65 intraday here. But my point is, not all bearish divergences are created equally. Not all of them are deadly. From 128 to 136 plus. Did you really want to miss out on that? Right? Did you really want to miss out on that? We're in a market where, yeah, I mean, the large cap growth names are in favor. Now, don't get me wrong. In the future, this bearish divergence might show up in materially negative price action. Either way, in my opinion, that would be opportunity. Not all bearish breadth divergences are. You have to take into consideration a weight of the evidence. This is just one piece, the RSI, of the weight of the evidence. It's not telling you the whole story as to why Amazon stock has bucked the bearish divergence trend so far. We'll see. We looked at, people are just still bearish, folks. Bull market, bear market, most people still think bear market. Willie Delwich, put whatever label you want on it. Doesn't change the fact that this rally is not behaving like a bull market. Yeah, it is. You just give it time. Most people are just living in this, moment to moment market perspective. But if you give it time, right? How many times lately have we heard, oh yeah, the market breadth has definitely broadened out. We've got all of these advanced decline lines hitting record new highs. We got various sectors, industrials, technology hitting new all-time highs. Give it time. Nothing's perfect. The market isn't utopia. It doesn't deliver perfection. If you're only looking at the flaws, you're likely to miss that which is most important, which is price. Tom Lee, this is a funny one. This is not a bear market rally. True, it's not, folks. There's never been a 9-month bear market rally. I mean, come on. 9-month bear market rally. Stop it. However, in the same thread here, this person says, nope, this is not a bear market rally. It's just going to be the shortest bull market in history. Now, for those of you at Finom Group, you recall that the shortest bear market in history actually just happened. From the March 2020 low to the peak January 2022 high, which was, maybe coincidentally, 22 months. Shortest bull market in history. So here's the real question. Considering this person thinks it's just going to be the shortest bull market in history after we just had that, what do you think the probabilities are? What do you think the odds are that we're going to have yet an even shortest bull market in history after just having the shortest bull market in history? Like, it's going to happen back to back? Really? I would venture to guess those odds are very, very low. Not everybody's bearish. Some folks are pretty bullish and have been all this year, like Dr. Ed Yardeni, who thinks that now it's possible that if we get above 4,600, we could probably make new all-time highs, 4,800 plus this year. Credit Suisse's Jonathan Golub raises the S&P 500 price target for year end to 4,700 from 4,050. It's funny how price changes sentiment. You want this to be more about the analysis, right? It's not, folks, because nothing's changed in the macro environment this year. We still have trending growth around 2%. It's not changed since the beginning of this year. Earnings may have inflected off of the bottom by the end of this quarter. Nothing's changed. Everything that we knew at the beginning of the year is taking form, is still trending. The only thing that's really changed is price. It's funny how it works. All right, chart that we had put in our weekend research report, and this is from Nautilus Research. I did want to highlight, go over, so that we have a full understanding of what the data is telling us. CPI year-over-year crosses below a 5-year moving average, which just happened. So how does CPI perform after this occurrence? 1 month later, CPI historically is still down 100% of the time. I'm sorry, not 100% of the time. This is the significance. But out of the 15 occurrences, CPI still moves down 1 month later, 13 out of the 15 times. 3 months later, 11 out of the 15 times. 6 months. I mean, you can see the majority of the time, the trend is your friend with CPI. It just keeps moving low on a month-over-month basis. All right, with that, this is our weekly state of the market. I hope everybody has a fantastic trading day. If you're not subscribed to our research, please consider subscribing today, and we'll see you next week.